Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday number 385, hosted by the Cal State Bakersfield Small Business Development Center. Good afternoon. It's July 22nd, 2026. And I think it's a fantastic topic. Those of you that know me, you know that I love cash flow, and we get a good discussion on working with cash flow and avoiding being a financially distressed business in this great age of great credit distortion. So, we're going to be looking today at a lot of the financial sides of operating a business. We're going to be looking at financial solutions that are presented and available to you as small business owners when you're faced with really tough choices. So we'll look at some of the tough choices out there, hopefully some easier decisions out there to be made, but looking at some of the options that are out there when you're looking at some financial issues. We'll also be looking at keeping your business healthy during economic uncertainty. We've been in a period for a considerable amount of time with economic uncertainty. We want to do what we can to keep that information flowing to you, to give you the best information and data to keep your business healthy, to where you're reacting to business conditions rather than them reacting to you. Our capital quarter is going to be on knowing your debt cost. Really, I think a fundamental aspect is when you get various or multiple financial streams, different loans, different, maybe potentially some equity sources, some other things out there, but particularly when you're stacking different loans. What are your debt costs? Our economic corner on where is this economy going? AI does déjà vu. We'll explain in just a little bit. We will have answers to your questions live after the presentation today. We'll have some news information and resources to help you thrive. Our resources, thanks to our webinar producer, Maureen Busher-Dan, are in the chat box. And I'm changing no poll today. We have a lot going on, plenty of time for our guests. So we'll move on to our regular features, the first of which is Capital Quarter. And on your Capital Quarter today, which is tying capital needs and accessing capital with today's topic, we're going to look at strategies for reducing debt. And so strategies for reducing debt could be understanding first and foremost your weighted average cost of capital. And there it is, your formula right there. A little more detailed on the formula that I prefer, but if you want the theoretic aspect of your weighted average cost of capital, and again, what that's going to be is going to be taking multiple loans that you have in your business, applying the interest rate, assuming that they all have different interest rates, they have different terms, they have other aspects that are unique to them. So with that, you can actually get a interest rate that you pay for the aggregate of those business loans. And that's what we're looking to get with the weighted average cost of capital. So we're looking at, and this is when you have equity and debt. We're going to probably use an example, which is more common for us, is that it's straight debt. And you can factor in other things such as corporate tax rate and cost of equity, cost of debt, etc. But I like to use this little thing. It's just a little simple Excel spreadsheet. And what this will do is it will list here, we have three simple, maybe four simple different areas of debt. In our particular cost of capital weighted average example for ABC Enterprises, you'll see what the debt is in the left-hand column. You'll see one is a business credit card. I think those are relatively common out there from at least a few of the local providers here. I know a couple of credit unions in Kern County, such as, throw a shout out to Valley Strong Credit Union and also to Alta One, who have a business credit card that is open and can be used like a line of credit. So this one maybe has a little bit larger balance than maybe the ones I referenced earlier, but hey, we'll look at everything here. So that has a balance of 37,000. The interest rate is basically 12%. So of the total debt that's here, the total debt outstanding, it is about 27% of that debt. Then we also look at other things. We talk about merchant accounts at times, and we'll probably get a little of that in the conversation today. Uh, but merchant credit accounts, in this case, the interest rate off of it is 32%. There's your balance and your percentage of debt. Also, we have an SBA loan. An SBA generally at 10.5%. Oftentimes, those are far more common than not. They are variable loans that are tied to interest rates, whether they're rising or falling. It is adjusted quarterly. This one's currently at 10.5%, and it is for the most part of this, the $69,000. And then we have another credit card that could be personal, could be business. People do get business credit cards or personal credit cards and use them for business. It happens all the time. But let's account for that and let's put it where it is. And it is a business tool here. So with this, you'll see that our weighted average cost of capital in looking at these different interest rates of these different four loans between 10.5% and 32.5% is it blends out to 14.89. So we're talking here about strategies for reducing debt. So what do we want to do is we want to look at getting rid of the highest interest rates off of here. And obviously that would be the merchant credit account at 32% and the credit card number two at 21. Now, is there a way for that balance there of taking those two credit cards or two cards to debts that are approaching basically $31,000 to $32,000 and maybe offset that with some other debt? And maybe we look at even offsetting and combining the business credit card. So that is one strategy, is to identify, is to figure out what your average cost of capital is, 14.89, and then let's look at some strategies for reducing that. And so there are some of the actual factors there, and really understanding your debt load with that. We see a lot of the different debts that we just discussed, but really what's coming down to is really the APR, the annual percentage rate. You are required by law on many of the commercial debt products that are available to consumers that is identified to you. And that is on an annual basis, the cost of that interest that you're getting. Now, on many accounts, they can skirt that, particularly on the merchant credit accounts, some fintech offers that are out there, and just show you some of the terms. They'll show you the terms and condition of your debt. We're going to collect every single day $120 out of your checking account. And we're going to do that over a term of 9 months. So oftentimes that is how you have to basically figure out the length or term of your loan and also the amount of the payment to then come back and figure out what your annual percentage rate is on that. So also, we talk on Webinar Wednesday a lot about our economic corner. And oftentimes we look at a lot of the challenges that are in the central and southern San Joaquin Valley and how they are in relation to the rest of the United States. So there's a great little tool that we've accessed, the Federal Reserve Credit Survey that they do on an annual basis. The Federal Reserve asks, and it's rather detailed survey. I'm sure many of you have done it, or at least some of you, because by doing so, we're able to work with our associate SBDC, the Valley Community SBDC, located in Clovis. We're down here in Bakersfield. So covering these 7 counties throughout the San Joaquin Valley and Eastern Sierra, we're able to get our own subset of data. So thank you, Federal Reserve, for that. And so tying that into today's presentation, what we want to do is we want to know what the financial condition at the time of the survey was for, which ended up being 70 of you that actually filled out and completed the survey. So we have a sample of 70 out of a U.S. Employer sample of 6,500. And we can see how we compare and how we differ nationally for some of the issues that are happening. Important to know. So if you look at this first question, which was the financial condition, and so basically their business owners are self-reporting the financial condition, and they're given other more than one option. So it will kind of be over 100%. So you're giving a couple of different choices in many cases. In this case, it's going to be only one choice because it's poor, fair, good, very good, or excellent. So, which the excellent number was higher both nationally and locally? It's not. But really looking at the big differences here is we do have higher firms than across the country who are reporting poor, and we have less that are reporting fair. So it's those two worst categories of where we're a little higher in the worst category and not as high in the fair category. The others are relatively within 1 percentage point and not so different. So financial condition, you can say we're a little poor than average on that. Looking at the financial challenges over the prior 12 months, with this particular survey, what we're looking at, and you can actually have multiple choices for this answer. So we're looking at basically how, what are some of the challenges and financial challenges that businesses have, and how do they relate to our area? So first and foremost, we're going to look at number one is our businesses throughout our 7-county region for this data suggests that the cost of goods or services or wages is not as big of a financial challenge as it is for the rest of the country. So we're less on that. We go through those middle ones with uneven cash flow, paying operator expenses and weak sales, even to a certain point, making payments are relatively close to the national average. And then we are significantly less on increased cost associated with tariffs. So this is telling us that we're not as affected by increase of costs of goods, services, or wages, and that tariffs have not been as big of an impact on us locally. Some of the operational challenges that we can analyze through this data also include the operational challenges that businesses have. And you'll see the first one. One of our bigger operational challenges for our area is reaching customers and growing sales, significantly higher than the national average. You'll also see that utilizing technology is an issue. So this tells us that we need more marketing support and utilizing technology in that marketing support, which we're prepared to provide you here at the Cal State Bakersfield SBDC. On the good side of things, hiring and retaining qualified staff is not near as big of an issue as it is nationally. Also, supply chain issues are not near as big, as long as ensuring the health and safety of customers and employees in our workplace. So a mixed bag on operational challenges, customers and technology. You need to contact the SBDC. Come on, that's all you need to do. And also some of these other issues are not as big of a factor for us. So those actions that are taken in response to the financial challenges over the last 12 months, for us, more of our businesses use personal funds and cash reserves. Fewer of us compared to the national average reduce cost or raise prices, which I found to be fascinating. Pricing is such an incredibly difficult strategy, but it's really an important strategy that we preach here at the SBDC. Also, we were less inclined to increase our debt load or downsize operations. So some of the actions really really interesting from that standpoint of particularly not raising prices. So we have our wonderful AI in question mark, which ties AI to our particular topic this week, which a lot of that is the financial data. And so it's financial data that we focused on last week. in order to, with webinar number 384, Webinar Wednesday 384 on AI. Really, I can say you can talk to our advising team. We have some fantastic programs that we're running in AI. Talk to our people. Our tools that we have to assist you at the SBDC are all here. There they are. A lot of different tools, including our YouTube channel, where many of you might be viewing this right now, is right here on our YouTube channel. So also a lot of different resources that you see there. We can assist your business with a lot of some brilliant AI advising and more. Coming up on webinar Wednesday 380 on July 29th will be Megan Hodap, who's with the small business manager of the iBank, which is the California Infrastructure and Economic Development Bank. We're here only because of the fantastic, and I do say the fantastic number of individuals and organizations that are on this screen. So thank you all so much, from the County of Kern, California, Kern County, California, to the College of Business and Public Administration. Thank you all so much for being here. And you can sign up for confidential, no cost, no obligation expert consulting. And today's special guest is Ben Nicholson. He is the president of Fortis Business Advisors, a diversified financial advisory firm providing financial and capital advisory. Also, turnaround and restructuring, asset monetization services to privately held businesses and their stakeholders. With over 25 years of experience, Ben has owned, operated, and advised businesses across multiple industries, including retail, food service, publications, marketing, and professional services. His background in startups, operations, turnarounds, liquidations give him an owner's perspective on financial and operational challenges. Yes, that's why we went over the financial and operational challenges today, and the practical decisions businesses face. Ben is the creator of the Great Credit Distortion, a framework examining changing credit conditions and how they are affecting privately held businesses, writes and speaks on small business credit, liquidity, distress, and recovery strategy. He holds an MBA and also a Bachelor's of Art, a member of the Turnaround Management Association, the American Bankruptcy Institute, and Secured Financial Network. Ben, it's great to have you back on Webinar Wednesday. Grab that mic and take it away.
My name is Ben Nicholson. I'm the president of Fortis Business Advisors. Before we get into this, I was paying attention to the polls that you had. I'm kind of scooting off to the side on this. That was very helpful. I think for some of y'all that are watching this, we may be able to not address them necessarily, but potentially give you some tools to help with it, especially with cash flow. The thing that did pleasantly surprise me, obviously, on our end of the market, we deal with people that are in oftentimes troubling debt situations. So if anybody is picking up on that, or if you're approaching something of that at some capacity, hopefully some of what we go through today will assist with that as well. So with that, let me go ahead and get started with what we got. I'm hoping everybody can see my main screen over on the side here. So again, Ben Nicholson, Fortis Business Advisors. Just quick background at Fortis. As part of the services we provide, we're a comprehensive financial services firm, but as part of the services we provide, we work with small Main Street business owners, lenders, attorneys, and other stakeholders that deal with small companies when a company begins experiencing financial distress. Sometimes the business recovers, sometimes it restructures. It can sell assets, or oftentimes it transitions through an orderly liquidation. We're going to touch on a lot of this as we go through today. And also, I think it's definitely important to point out we've got a Q&A session at the end. So if anybody develops any questions, please feel free to ask them. Every situation is different when you get into distress, but one thing that is remarkably consistent: businesses rarely fail because of one bad day. Financial distress usually develops gradually. As cash gets tighter, decisions become harder, and options begin to disappear. Today is not a technical or accounting or bankruptcy presentation. It's a practical framework recognizing on how to recognize distress earlier, improve visibility, make better decisions, and preserve optionality while good choices are still available. So let's get going with it. Let me begin with a question I hear frequently in our office. Why does financial distress feel different today? Today. Business may still have customers, plenty of revenue, employees are bumping around, everybody's happy, and a strong backlog of business or sales or projects to complete. Yet cash flow gets tight, credit has gotten harder to obtain, and vendors are starting to get a lot less flexible. It's not uncommon for a company to remain busy while becoming financially weaker in the background. Simply put, activity is not the same thing as a healthy business. A full schedule does not tell us whether the company has enough cash to meet the obligations created by that activity. If running a business feels harder than it did 15 if you've been around that long, 10 if you've been around that long, or frankly, even 5 years ago, you are not imagining it. The environment surrounding running a business today has changed for some fairly dramatically. I refer to that changed environment as the Great Credit Distortion. Now, for more than a decade, businesses operated with unusually cheap and abundant capital. For those of you that have SBA loans, you may have seen your SBA rate, or if you've got fixed rate, variable, won't go into details, adjustments in those rates. Previously, refinancing was often available. Temporary cash shortages could frequently be borrowed through. This was allowed for, in some cases, operating problems not getting actually solved, but rather financed. Today, however, rates are higher and there's very little chance of their going down. We were monitoring this as far back as 2024, and we were saying rates are not going to be coming down to a level people were hoping that they would come down to, much less, or even all the way back to 2021. And in today's environment, credit has gotten considerably more selective. Lenders are examining performance and cash flow way more closely, and stakeholders are protecting themselves. There's still a lot of flush capital in the market. There's still a lot of access to capital, but the people who are holding it, that are giving the access, are tightening down considerably. Now, what's also happening is on the other side of this is narrowing options to recovery paths. The point is not that credit is unavailable. The point is that the rules have changed considerably. Decisions based on the old rules in today's world will overestimate options and cause owners to wait too long. Revenue is not liquidity. And as I was looking at the poll, that was one of the things that kind of captured me a little bit. And you may be completely accurate, which is absolutely great. But I just want to make sure you kind of see where my head is with that. One of the most common mistakes we see is treating revenue, profit, cash, and liquidity as though they're the same thing. They are connected, but they are not interchangeable. Revenue tells us if the business is generating sales. Profit tells us whether those sales produce an accounting return. Cash tells us what is available in the bank. Liquidity tells us whether the company can meet obligations when they come due, creating time, leverage, and choices. In short, good liquidity creates optionality. Alternatively, a profitable business can still run out of cash by growing too quickly, carrying too much inventory, collecting too slowly, or taking on more debt service than operations can support. Or more poignantly put, a phrase that we often use in our offices is profit will tell you the score. Cash flow tells you if you're even still in the game. So let's talk about optionality. It's the most important concept in this presentation. It simply means the number of good decisions still available. Can the company borrow? Can you raise capital? Can you negotiate with vendors or creditors? Is there an option to restructure? Are there assets that can be used to restructure? Are there assets that are good enough to be able to sell? Can you actually sell the business as a going concern? Or on the other side, can you conduct an orderly liquidation that preserves recovery rather than an emergency sale which sells for pennies on the dollar? The danger is that optionality rarely disappears all at once. It erodes gradually. A lender loses confidence, taxes become delinquent, a vendor changes terms, inventory ages and not replaced, employees leave, or even in an exit strategy, a buyer ultimately loses interest after a whole lot of due diligence and work has been done. Every month a problem remains unmanaged, another option may disappear. The central objective in distress is to preserve as many good decisions as possible for as long as possible. That leads to a difficult truth. Delay is not a strategy. Can't emphasize that enough. I want to repeat it again. Delay is not a strategy. Business owners are naturally optimistic. As Kelly had said in the beginning, I have owned several businesses over my career. Practically part of a criteria of working with our firm is having business ownership in your background. So we approach things with business owners from the business owner's mentality. We get it. Business owners are naturally optimistic. They have to be. But optimism becomes dangerous when it replaces analysis. Hope does not change the economics of the business. Also, time without operational change usually reduces cash, stakeholder confidence, collateral value, and choices, ultimately. Waiting is just not neutral. Now, the answer is not panic, it is disciplined action. Understand the problem, determine how much time is available, and use that time to make changes. Time has value only when it is used. So, how do we recognize financial distress early enough to act? Begin with practical questions. Can you make payroll? Can you pay payroll taxes and sales taxes when they are due? Can you service the debt? Can you replace the inventory or materials required to keep operating? Can you forecast your cash position over the next 90 days? Many owners know today's bank balance, but not what it will be 3 weeks from now. That absence of visibility is itself an early warning sign. If you cannot answer the questions on this slide, start here. You cannot manage what you cannot see. This is the distress decision pyramid that we think through when we are discussing with clients the strategy. This pyramid shows the order in which we believe a distress situation should be evaluated. Owners often jump directly to solutions, get another loan, an MCA even, merchant cash advance, cut expenses, sell the business, or just stop making payments to vendors. Those may become the right questions, but they are not the right starting point. First, start from the bottom of this pyramid and move up. You got to understand the environment. Next, establish liquidity truth. Where is cash really headed over the next 13 weeks? Then, understand the company's obligations, which create personal exposure. If you have an SBA loan, you are most likely personally exposed. Which stakeholders can interrupt operations and which payments may be negotiable. With those facts, management can make better decisions and communicate credibly. The result is preserved optionality. Better decisions begin with an accurate understanding of the environment, cash, and obligations. Now, establishing liquidity truth. For those of you that answered in the poll about your cash flow, in this document that I'm going to show you on the next slide will be provided to you, or you can reach out to me and I'm happy to send it to you as well. But your SBDC will provide it to you. So the 13-week cash flow statement, if there is one management tool I wish every business owner understood, it's the 13-week cash flow forecast. We use this tool in M&A advisory at the origination of a loan. We use this tool in distress situations. If a business, now the SBA, more times than not, is not going to recognize this tool. It's not part of their general way of doing things when businesses fall in distress. But if you're in a normal bank loan and you're working with a special assets officer or a workout officer, good chance they're going to actually request this. And if you are in a bankruptcy, the court usually requires it. For presentation purposes, I'm providing it more in this discussion as a tool, because that is what it is. It is a visibility tool. It's just a matter of if you're going to be using it to get visibility for yourself with your operating business as opposed to somebody else asking you for it. So why 13 weeks? 13 weeks is a quarter, 4 quarters out of the year. 13 weeks is long enough to see problems developing, but short enough to forecast with reasonable discipline. It forces management to move beyond today's bank balance and look at receipts and disbursements week by week. It's a prediction tool, but prediction is not the full value. Prediction is the tool. Preparation is the value. No forecast will be perfect. Customers pay early or late, expenses change, equipment breaks. That does not make the forecast a failure. The value is seeing possible shortage before it becomes a crisis. If cash falls below the payroll requirement 4 weeks from now, management has time to accelerate collections, negotiate with vendors, reduce purchasing, defer discretionary payment, communicate with a lender, or make an operating change. The spreadsheet projects, preparation changes the outcome. Here's what it looks like. And don't worry about reading every number on this slide. The purpose is, I'm not here to teach you this as a spreadsheet. It's just to show you the operating discipline behind it. The structure is simple. Begin with available cash, estimate weekly receipts, identify weekly disbursements, calculate an ending cash, and carry it into the next week. Well, let's get into it for just a little bit deeper. Beginning cash. This is the opening cash balance in your bank accounts beginning whatever week you're starting. Sales revenue, cash-based sales revenue, or AR collections, depending on the nature of your business. These things can adjust. This is not static. But let's say you're doing some sales revenue for cash sales and AR collections. You can see customer deposits, other ways of bringing cash into the business. That'll give you your total cash inflow. Your total cash available is that beginning balance plus the inflows to give you the availability. Then your disbursements. This is what's going out in cash by looking at your bank statement and projecting what you anticipate going out that week in cash. If you've got and this will give you your operating expenses from a cash perspective. If you got other disbursements, you can throw those in as well to give you full operating cash flow before your debt service. This tells you if your business structurally is operating properly and kicking off enough cash to give you enough cash to service your debt, your SBA loan, line of credit, MCA, and very importantly, we can touch on this in the Q&A if you want to, your EIDL loan. EIDL loans, we're seeing some challenges with EIDL loans these days. MCAs we've been seeing for a long time, but EIDL loans nowadays. So give you your total disbursements, weekly net, difference between what you brought in and what you took out, cumulative cash flow, explainable, gives you an ending cash balance. This ending cash balance right here is what starts week 2. You go week by week by week over 13 weeks. If your SBA loan is paid on the first week of the month, it comes in here, what that total amount is. If you know what your labor is, payroll, whatever, if you're paying every other week, you put it in whatever block every other week. And as you can see, when these numbers start going down or they start going into the red, this gives you the visibility that you need to know that you can make adjustments somewhere in order to get it to where those numbers are not in the red. If they stay in the red, you may be having some structural issues that you really need to hone in on. Things like customer acquisition costs, payroll, things like that you might need to look at structurally. All right. So the real work in this is in the assumptions. Which receivables are collectible? Okay. When will they be paid? That's what comes in these collections. If you know your vendor or receivables getting paid in this week, then you can put it in this week. But if you think it's going to be delayed a week, better safe than sorry. Which disbursements are necessary to generate future revenue? Which payments can be negotiated without creating a larger problem? You can see how this gives you optionality. Now, this forecast is updated every week. Actual results replace estimates. So after you get through week one, dig into your bank account and replace these with the actuals and see what it does, because this will populate through the spreadsheet, okay? Because you want to make sure that stays positive. So replace the actual with actuals, variances get explained, understand them, and challenge your assumptions through the future projections as you get more actuals. And over time, it becomes the company's weekly operating plan. What this does is, instead of saying, I think we will be okay, management can say, here is where the pressure occurs, and here is what we're doing about it. That improves both decisions and stakeholder confidence. Quick case study. It's a live example. Well, former client, live example. We worked with a home services company that had appeared successful from the outside, multi-million-dollar company. It had customers, employees, meaningful revenue, healthy demand. But cash never seemed to match the activity in the business, and payments were being made based on whichever obligation was most urgent. This led to them taking out a merchant cash advance loan. The opening cash balance included in their 13-week, when we prepared it, included the MCA loan, because it was in that cash from the loan was in their bank account. We made a point to ensure that it was understood that any weeks where cash inflow wasn't higher than outflows, not only would they be using the MCA to cover the shortfall, they would be paying the MCA with the MCA's funds. So it was imperative that they stay positive every week, or what could ultimately end up happening is you run out of cash again and find yourself going to another MCA and doing what we commonly refer to as MCA stacking. That 13-week cash flow statement will help you prevent that. When we prepared the 13-week cash flow, a developing shortfall became visible. It was not obvious from revenue or the current bank balance, but it was clear when receipts and disbursements were placed on a weekly timeline. That visibility changed the conversation. Management had time to accelerate collections, reschedule certain disbursements, tie spending to the cash plan, and contact stakeholders before missed payment. The important lesson is not that a spreadsheet saved the company. A spreadsheet cannot make decisions. Visibility changed management behavior, and management behavior changed the outcome. Once liquidity is visible, the next question is, who must be paid and in what order? Many owners pay the person making the most noise. That's understandable, but not always strategic. Sometimes the person making the least amount of noise is the one that can cause the most harm. And the person that's making the most amount of noise is making the most noise because they end up being the one that can't cause much of any harm. Different obligations carry different consequences. Taxes can create personal exposure. A secured lender may have rights in receivables, inventory, and equipment. An MCA provider may act quickly, Critical vendor, landlord, or utility provider may interrupt operations. The objective is to understand the legal, operational, and financial consequences of each decision. In distress, every dollar must be allocated with intention. This slide takes that analysis one step further. I often ask an owner, who has the ability to materially hurt the business next week? The answer is not always the largest creditor. A relatively small obligation may be more urgent if it can stop operations or create personal liability. Each stakeholder has a different combination of leverage, flexibility, and exposure. Prioritization cannot be based only on balance size, and the stakeholder with the greatest ability to disrupt the business should not, and I repeat that, should not be the last person to learn there is a problem. The purpose is to replace vague fear with a practical assessment of who can act, what they can do, and how quickly they can do it. Now, we'll shift in today's credit reality. Many borrowers are dealing with debt structures created under very different interest rate and credit conditions. A loan that looked manageable when rates were low, say 2021, may be difficult to service today, and a business that expected to refinance may discover that lender standards have changed. We are also seeing some structured SBA workouts, idle servicing challenges, and the effects of high cost capital, such as merchant cash advances and factoring. We touched on that a little bit earlier. Central point is to know today's rules before choosing strategy. Lenders generally respond better to credible information than to surprises. Communication does not guarantee cooperation, but silence almost always reduces confidence. And I will tell you, when dealing with lenders, that 13-week cash flow projection that is used by us when we are talking to lenders, because it gives the lender visibility. It gives them the option to take considerations that if they're not seeing with that level of visibility, they may not entertain. All right. If I could speak with every owner before distress became urgent, these are the points I would want them to understand. Distress rarely gets better on its own. Time does not get you out of that. You cannot borrow your way out of an operating problem. New capital may provide time, but it does not correct negative margins, poor collections, excess overhead, or an unsustainable business model. Also, waiting reduces options, and not every debt deserves the same priority. And finally, asking for help early is not failure. It is a strategic decision. The earlier the facts are established, the more tools are usually available. Now, business owners naturally focus on the most visible issue. Understandably, sales are down, so the answer must be more sales. Profit is weak, so the answer must be expense cuts. Cash is tight, so the answer must be get another loan. Sometimes those conclusions are correct, but they also can make the problem worse. More sales may consume cash if margins are weak and customers pay slowly. Cutting the wrong expenses can damage revenue. A new loan can postpone the problem while adding debt service the business cannot support. It's imperative to evaluate liquidity, margins, debt service, working capital, and the capital structure before you choose a remedy. Again, the correct treatment depends on the correct diagnosis. Now, a quick word about liquidation. We are liquidators. We work and serve our clients on that end of the exit situation, if you will. It's understandable. It often creates an immediate emotional response, and owners hear it as failure. We do not view it that way. Liquidation is one strategic option among several. The business may continue as a going concern. It's possible. Restructure, especially if operations are restructured. You could sell assets or even sell the business as a going concern. You can transition through a receivership, or you can conduct a structured liquidation. The critical distinction is between an intentional decision and a forced reaction. An orderly process conducted while records are available, assets are organized, and stakeholders are cooperating can preserve substantial value. Waiting until cash is gone and creditors are acting independently usually destroys value. The objective is to compare alternatives honestly and protect value before it disappears. And again, for those that have personal responsibilities in some of this, this can affect that. Now, if you remember nothing else from today, I encourage you to try to remember these 5 rules. Understand today's environment, know your liquidity, understand your obligations, communicate early, manage weekly. Bank balance is not a cash plan. Different obligations create different risks. Stakeholders are way more willing to engage before a default than after a surprise. And distress does not develop quarterly. Collections, disbursements, and assumptions change every week. Visibility, again, going back to the original concept, creates better decisions. Better decisions preserve optionality. That is the entire presentation in 2 sentences. I'd like to leave you with one final thought. Again, and we've talked about this, businesses rarely fail because they suddenly run out of time. They fail because they gradually run out of options. There are many things an owner cannot control. You can't control interest rates, inflation, credit markets, or lender appetite. But an owner can control visibility, decision quality, communication, and preparation. This is not about predicting every problem or eliminating uncertainty. It's about seeing the business clearly enough, early enough to influence the outcome and preserve the ability to choose. Thanks for spending this time with me. I hope today's discussion has given you some practical framework you can use in your own business or with the businesses you advise for SBDC consultants that are viewing. The final thought, financial distress does not usually happen overnight. That's why there's often time to change the outcome if the warning signs are recognized and addressed early. My contact information is on this screen. I'd be happy to answer any questions that come through, or feel free to shoot me an email, and happy to help anybody that is running into some of these situations that we touched on.
Fantastic stuff, Ben. Uh, Love that 13-week cash flow, I got to admit. Love the 13-week. We've used the 12-month for ages, but the 13-week is just so hypersensitive to the issues, and looking at it on a weekly basis instead of jumping in on a monthly basis can make all the difference in the world. So
It's imperative.
love that. Got time for your questions, so jump in, and really now is the time to get those questions answered. So jump in the Q&A. We'll also check the chat before we're done. Ben, just to kick off the Q&A section, you talked about 3 pretty much interesting loan aspects from us at the SBDC, and that would be SBA loans, EIDL loans, and MCAs.
Okay.
Particularly with the idols, because we know that there is, with our relationship with SBA and others, we hear a lot of statistics that there are, a high rate of unperforming idle loans. Have you worked with anybody who has had issues with idle loans or SBAs or MCAs that you can give us an update on some of the current trends that are happening with those particular workouts and other issues?
So yes, and I'm gonna try to be almost too direct, because in a way it can get a little scary. So the nature of the auto loans, if we step back in time with these things, what happened with those is that when they came out, I'm sure a lot of people thought that they would be forgiven, much like the PPPs were. But just as a refresher to capture the narrative, the auto loans were a 30-year loan that was delivered at 2.75%, and over I guess it was a 30-year term, and there was a 30-month deferral before that first payment had to be made. We are getting distressed clients with idle loans coming in. I want to emphasize this because a lot of times what was happening is that the people were trying to start paying them again and they realize they don't have the cash flow to do it. A lot of times the business has already been shut down. Email addresses change, phone numbers change, you name it, all kinds of different situations. This is the most important part of this. If you default on an idle loan and it moves towards treasury and it moves towards justice and moves to collection, there is a 30% non-negotiable fee that is attached to it, and they are actively going after collections without negotiating. Now, I want to put this in context. The United States government can borrow money today at 3.25%, 3.24. Idle loans are sitting out there at less interest rate than what the federal government can borrow money at today, at 2.75%. They are not negotiating. You really end up with three options. Pay it. If you can't pay it, you can end up in a wage garnishment or some sort of garnishment situation, or bankruptcy. Now, I will tell you this, and again, I don't mean to scare people. That's not what I'm getting at. I mean to emphasize the importance of what's going on, because a lot of times loans in the capital structure just kind of fall by the wayside. Going back to what I was talking about, the people who scream the loudest are sometimes the ones who can't do the most damage. The SB or the federal government can absolutely do the most damage. And we had, I mean, I'll give you a good example. I talked to somebody several weeks ago, or a couple of months ago now, that 15% of their Social Security was being garnished for an idle loan. They are not messing around with the idle loans. That's why one of the reasons I kept it on that 13-week cash flow statement is extremely important to keep that up. And we have been dealing with some call volume coming in of people that are struggling. Hopefully that answered your question, Kelly.
It did. And, just to work the acronym out, EIDL loan is the economic injury disaster loan, and those were popular during COVID. So they originated, most of them, or a lot of them, in 2020 and some of them in 2021. And a lot of them were made without any credit underwriting at all. And for a while, they were going out at about $150,000 a clip. So they're very
We've
widely
seen
out
some
there.
with more than that.
Yeah. Yeah. So they're out there. But the key, I think, is also right now is if you are falling behind, what you need to do is you need to contact the SBA and work with them directly before it turns into a situation like you described, Ben.
Yep, that's absolutely. Couldn't say it absolutely.
Work with that and don't
Work
ignore
with
it, because I wasn't sure of what was happening, the consequences down the road, but I just heard them a few minutes ago. So
Yeah, you really don't have. There's just no options. They're not really. Once it gets transferred, they're coming guns blazing.
okay, some questions. I'm retired, but I was an employee. What are some of the warning signs I should be aware of?
Warning signs. Clarify for me what we mean by.
That's a good question, because that's all the question I got. So
Okay.
I'm retired. I should be, some of the warning signs potentially I would think of, maybe some of the warning signs of business failure, business slowdown, business.
Well, I mean, we can go into the economics. And I'll give you some poignant things, particularly if you're on the retired side of it. For things to keep interest, right? Things that we look at in the economics that we pay a lot of attention to. If you're driving down the road, and every state's different. I know California is a lot higher. I'm all the way over in Georgia. If you see diesel gasoline going over $5 a gallon, that means that some challenges are coming. So just watch the signs up as you're driving down the road. Container rates, particularly from China to the West Coast and China to the East Coast, You can look up those container rates. If you see container rates coming through, they're getting higher. I think they're somewhere around $6,900 right now. I think at one point in time in COVID, they were up around $25,000, but they went down for a minute. They're coming back up. Things like that you have to watch out for. We're an economically driven firm, so we stay on top of this because we're trying to connect the dots, right? Inflation's not coming down. People believe that somehow a miracle's going to happen and it's just going to pop down. You can try to read it through different tea leaves, but the way we're seeing it, it's just not going to break with the way that things are going now. And again, we're not a political firm. We just look at it from the economics perspective. The U.S. federal debt reaching the levels of debt to GDP that it is right now, it's ominous. That because that contributes in certain respects to inflation. But even beyond that, I mean, you're going to see from Wall Street to Main Street to a different economist here and a different economist there looking at inflation and saying, hey, this is what's causing it. Labor is what's causing it. This is what, and they're all right. And which is all fine. But what it is really is the underbelly and the Great Credit Distortion. If you have interest in better understanding that, kind of walks through this to a degree. It's the plumbing and what's over at the other end of the plumbing, because as that liquidity is moving through the system, there's scarcity on the other side of those plumbing pipes that is driving a lot of this inflation, and that scarcity is directly tied to productivity. And if we're having productivity challenges, it's going to drive prices higher, and it's going to keep them sustained higher regardless of what we do. So hopefully hopefully it was looking to economics. I can get off on a tangent with some of that stuff, but I'll rear back and make sure everybody else's questions get answered.
Well, we got one more question, Ben, and it relates around the MCA, the Merchant Credit Agreement or account.
Merchant
Uh,
cash advance.
Merchant Cash Advance. I never get that right. Cash credit,
Yeah.
So that and some of the other fintechs, there's a lot of challenges with those. And what are some of the warning signs you see with those? And I know you've written a lot on MCAs. What can you tell us about MCAs?
Okay, so and great question, by the way. These are both the idle loan question and the MCA question. You're hitting it's great because you're hitting at a lot of the stuff that we're seeing a lot of prevailing things coming through on. So the MCA, how that I'm one of those ones, despite some of the things that I've written. I mean, they're not inherently bad or evil, if you will. They serve a purpose. But the problem that people were running into, and I had been interviewed about this one time, and somebody said, "Well, when is it appropriate to get an MCA?" I mean, we have some flippant comments for that that I'll spare you on. But some of it, if you can project it, particularly in that 13-week cash flow projection, and it gets you over the hurdle, they can be used, right? But you got to be able to service it. And you got to be able to sustain it because going through that case study that I went through, you can burn down that MCA and run out of cash with nowhere to turn. And so you end up turning to another MCA. And it goes back to what you were talking about in your weighted average cost of capital. You can have MCAs that we've seen them 40. I mean, we've seen somebody with 8 MCAs stacked on top of each other. And you're talking, 80 some odd percent. I can't remember if it may have been in the 80s interest rate. It's just, and it's unsustainable. Now, what the MCAs are doing, and the courts have a lot to do with this, particularly the bankruptcy courts, because historically what would happen is the MCAs would, first of all, if you get one, be very, very careful with the SBA because the SBA does not authorize you to get these. Right now, I understand emergency. I live in the mud chasing razor blades. I get it. I understand if you run out of cash, but from a strictly covenant contract agreement, if you have an SBA loan, you can't. If you get an MCA, you are doing what is known as priming the lender. But notwithstanding that, if you have one, they are changing some of their agreements The debt itself, and we've been in these types of conversations before, debt itself does not change. But they are burying in their agreements reconciliation clauses and adjustments to payment structure clauses. But it depends on you, the business owner, to adjust that as opposed to factoring, right? Where you get a receivable in and a factoring lender actually takes a percentage, advances against a percentage of the receivable. They're actually looking at a receivable, an asset. It's the receivable. With the MCAs, they're just going to continue to draft out of the bank account regardless. And the mistake that people will make when they get the MCA is they may be coming into the down season. But when they talk to the lender, they say to the lender, hey, this is what we do on a weekly basis, monthly basis, sometimes, annual basis, whatever it may be. And they're doing the math, and oftentimes that's at a higher revenue level. So when the MCA is saying, okay, we're going to take 4.5% of your weekly draws from the bank, or whatever, 4.5% of that revenue level that's hitting the bank account, if that revenue fluctuates, that number stays the same. And, the courts struggle with this because, again, they call themselves, I won't get into too much detail, but they call themselves receivables lenders when that type of fixed payment is loan, right? Your SBA loan is fixed payment. You know what it is every month. That's a loan. Versus the MCAs calling themselves receivable lenders. That's where the problems get into. So they've reworked some of the language in their agreements that allow you to call them and say, hey, my sales been down. I need to readjust how much that percentage, and we can help with this, but adjust what that percentage is, how much you're taking out on a weekly basis. And they may even say reconcile, and get some of the cash back. They're going to kick and scream on that, but it's possible. But the point being is that if you do that and you work through those challenges, it may save your business then. But make sure you understand 13-week cash flow. Make sure you understand that if that MCA, it will extend further out. The debt, any adjustments you make to it or to lower it, do not stop the total amount of the MCA. It bolts onto the back end of it and will extend your relationship with the MCA even longer, potentially going through your slow period, and can make the situation worse. So it's a bit of a balancing act, and but they can be worked with.
Great. Hey, well, fantastic information. We're out of time. So I will check you out in Atlanta later this year, Ben. And
Looking forward to it.
What's what?
Looking forward to it.
Right on. We'll have some fun. We'll have some fun in Hotlanta.
Good.
So great stuff. We'll be back next week. Webinar Wednesday number 386. We'll be talking about with the iBank, the California iBank. And Ben, back to your $5 diesel. We'd love $5 diesel in California.
Yeah, California is a little different. I monitor it on a national basis. I know California is a little different. I feel we deal with trucking companies. So we know, they're filling up in Nevada or they're filling up somewhere else trying to get through California and not stop.
Yes, sir.
We know it.
So we'll be back next week with number 386. Big thanks to Ben Nicholson. Everybody have a great week. We'll see you next time. Bye-bye, everyone.
Thanks, everybody.